As we get ready for earnings this week, more S&P companies are beating earnings estimate than ever before and by a wider margin. The S&P is now reporting the third highest earnings since Q2 2010. In this video, we'll do a quick recap of the earnings report so far and look at key companies that are reporting in the week ahead.
Hey guys, it's Amber and Jared here from Holy City Family. Our mission is to empower you to achieve financial independence so that you can pursue your dreams and ambitions.
If it's your first time here, thank you for joining us. Subscribe to join us on our FIRE journey as we learn, save, and grow together.
Subscribe to our channel.
Please.
Subscribe to our channel. Can you please? Can you please?
Before we jump into earnings this week, let's take a look at a recap of the results so far. This amazing chart was provided by Refinitiv on Tuesday, November 2nd, 2021. The left side shows the results for the earnings, the right side shows the results for revenue. The blended growth rate for the S&P 500 are 40%, and take a look at energy, 1,745%. Wow. It's still crazy, even similar, I think it's even up a little bit from last week. For revenue, the numbers are 15.7%, energy is at 75%. And for the scorecard, 83% of companies reported earnings above estimates. 77% reported revenue above estimates. Take a screenshot of this chart and take a closer look after the video and check on Refinitiv to get the latest update. I believe they're doing it every single day. And we'll also put a link in the description below. Okay, now let's take a look at the earnings for this week. On Monday in the morning, we have the trade desk. After close, you have companies like PayPal, Plug Power, Trex. On Tuesday in the morning, you have Palantir, BioNTech. And then after market close, you have DR Horton and Coinbase. On Wednesday in the morning, Monday.com. After close, you have Disney and SoFi. On Thursday morning, you have Wix and Tapestry. And then after market close, Pinduoduo, Applied Materials, XPeng. And on Friday in the morning, AstraZeneca. After market close, Honest.
And we wanted to remind you guys that there's like hundreds of different companies that are reporting this week. These are just some that we kind of chose to highlight for you guys. So let's take a look at some of the companies that we're featuring for Monday. PayPal Holdings Incorporated operates as a technology platform and digital payments company that enables digital and mobile payments on behalf of consumers and merchants worldwide. It's trading at 4.8% below Simply Wall Street's estimate of its fair value. Its earnings are forecast to grow 19.75% per year, and its earnings grew by 88.5% over the past year.
Okay, now let's take a look at the snowflake analysis. As you can see, the future growth, past growth, and financial health look pretty strong with PayPal. Value not so much, and it does not offer a dividend. Here's some product highlights for PayPal. PayPal has a buy now, pay later with pay in 4, and that's 4 interest-free payments that they allow you to make instead of paying for it all up front. You can check out with crypto now, and you also have touch-free payments with QR codes. Also, PayPal has over 400 million PayPal users, which we were surprised to hear that. In PayPal's one-year chart, you can see that they're up 22.53%, and right now they're at a 26% drop from their previous all-time high. And here's the latest news on PayPal. We highlighted 3 articles that we found, and we'll have these links in the comment section. The biggest thing right now is that PayPal, it sounded like last week they were potentially going to purchase Pinterest, but now it seems like they either changed their mind or they weren't never going to do it in the first place. Nobody's really clear on that. So the stock went down and then it jumped back up, and now I think everybody's still trying to figure that out. Now for the like versus not. What we like is that they have a narrow economic moat. They have 46% debt to equity ratio, 24% long-term growth. They're currently undervalued, a 547% 5-year return, 25% return on equity.
And now for what we don't like. They have a 53.66 forward PE ratio, a 1.63 forward PEG ratio. They have a 26% drop from ATH, and then that downtrending chart that we just showed you with the 1-year view. So here we are on Tuesday. And on Tuesday, the first one that we're going to highlight is Palantir. Palantir Technologies Incorporated builds and deploys software platforms for the intelligence community in the United States to assist in counterterrorism investigations and operations. Its earnings are forecasted to grow 67.48% per year, and its revenue grew by 47.4% over the past year.
If you look at the snowflake analysis, you can see that Palantir's future looks bright with high future growth and also really good financial health. On the past growth side, pretty low, and also on value and dividend. For Palantir's product highlights, we're going to start off by letting the CEO, Alex Karp, share his thoughts with you.
Software is moving from a luxury product you can afford to ignore in your IT department while it fails to the thing that will determine whether you survive as an industry or, quite frankly, if you can defend yourself and act aggressively or correctly passively as a government.
And if you didn't know, Palantir builds software that empowers organizations to efficiently integrate their data, decisions, and operations. And as far as their platforms go, they have some pretty cool named ones, Foundry, Gotham, and Apollo. And their website is a great resource. You can click on any one of those and learn a ton of information about each one. Here's what makes Palantir's software so powerful. Number 1, day 1 value. Number 2, decision advantage across your organization. Number 3, full stack interoperability. Number 4, military grade security and data privacy. Here's Palantir's 1-year chart. As you can see, over the past year, the price has increased 152%. Okay, here's some of the latest news. One article in particular that we wanted to focus on is from Seeking Alpha. And this article is, it's earnings season and Palantir is set for a breakout above $30. Based on previous trends, Palantir is on track to exceed $1.5 billion of revenue in 2021, which will blow out their 30% annual year-over-year growth estimates. What we like, Palantir is very popular on Wall Street. It has a narrow economic moat, a 0.96 forward PEG ratio, and we look for companies to be below 1, so this meets our requirement there. It has a 12% debt to equity ratio, and if you recall, we look for companies to be under 40%, so it meets that requirement. And it has a 49% long-term growth.
Now what we don't like about Palantir, it has a 125.53 forward PE ratio. It's slightly overvalued, there's no margin of safety, and it IPO'd in September 2020. Now for another company that's going to report on Tuesday. Coinbase Global Incorporated provides financial infrastructure and technology for the crypto economy. It became profitable this year, it has a 66% long-term growth rate, and has a 41% debt to equity ratio.
Now for the snowflake analysis, it has strong financial health, about average for past growth, and it looks kind of weak on the value and future growth side.
Take a look at this video for some product highlights of Coinbase.
Here's the 1-year chart for Coinbase. As you can see, the company recently IPO'd and their past performance in the past year is 35.89%. Here are some of the latest news articles for Coinbase. We wanted to focus on one, which is from CNBC. Coinbase stocks rise after Facebook taps it for help on new cryptocurrency project. So first, Facebook changes its name to the metaverse, and now it's doing cryptocurrency. And this says that Coinbase said it would be storing the cryptocurrencies that Facebook will offer to users who sign up for its digital wallet called Novi. Coinbase stock was up 2% following that news. Okay, now the likes versus not. What we like about the company is that it has a 41% debt to equity ratio, a 21 forward PE ratio, a 68% return on equity, and a 66% long-term growth.
And what we don't like, it IPO'd April 14th to 2021. There's no economic moat and there's no margin of safety.
Subscribe to our channel.
Please.
Subscribe to our channel. Say please. Say please.
Say bye-bye.
Get in my
So moving along to Wednesday, and Wednesday we're going to focus on Disney. So here you can see Walt Disney Company together with its subsidiaries operates as an entertainment company worldwide. It's trading at 29.4% below the SWS estimate of its fair value. Its earnings are forecast to grow 32.4% per year, and it became profitable this year.
As for the snowflake analysis, you can see that the company looks good for future growth, not bad for past growth, and also for value. For Disney product highlights, we thought we'd just show you the Disney Plus trailer that aired last year, but it does a great job of walking you through Disney.
What is this? This is a story. It's an idea. It's about chasing your dreams and looking beyond.
Let's go on and light this candle.
That's my line.
We hope you guys liked that trailer from Disney Plus. That's pretty cool. Also for product highlights, we wanted to walk through some of the properties that they own. They have Disney parks, and they have a number of different Disney parks all over the world, not just in the US. They have media and entertainment like Disney Plus that we just talked about, ESPN, Hulu, Hotstar, Disney Music Group. And then for content groups, they have companies like Marvel Studios, Lucasfilms, Disney Theatrical Group, and 20th Century Fox. For the 1 year chart, you can see that in the past year, Disney has gained 38.87%. Okay, here's the latest news on Disney. One article we wanted to focus on is from The Motley Fool, and it's why Disney looks unstoppable over the next decade. It talks a lot about Disney Plus, and it specifically talks about their potential to grow and how we really haven't seen the full potential of Disney Plus. And that time is coming as long as they keep coming up with compelling content and really awesome stuff like The Mandalorian. Here's what we like about Disney. They have a wide economic moat, 33% long-term growth, a 0.27 forward PEG ratio. They launched Disney Plus in 2020, and like we just read, we still have not realized the full potential of Disney Plus. They own Star Wars, Marvel, ESPN, Hulu, and the new Disney Plus series are very popular. They've been really successful with creating their own content and launching it exclusively on the Disney Plus platform. They also are releasing Avatar 2 and 3 over the next few years, which Avatar 1 was the most popular movie ever.
All time, yeah. And what we don't like, it has a 272 current PE ratio, 69.8 forward PE ratio, a slim margin of safety. A sell signal was triggered on the monthly MACD recently, and it has a 1% return on equity. Also on Wednesday, a company that's reporting is SoFi. Social Finance Incorporated is a finance company that operates on an online platform that provides financial services. Its earnings are forecast to grow 69.45% per year. It has a 0.77 forward PEG ratio, and it has a narrow economic moat.
On the snowflake analysis, what you can see pretty clearly is they have a great future growth prospect. Their financial health is a little below average, and then they look low on the past growth and value. Here's a great trailer that we found that highlights SoFi's products.
Feel stuck with your finances? Move your money to SoFi and feel what it's like to get your money right.
I jump up on the stage and do my money dance. I throw some money up and watch the money land. I do my money dance. I do my money dance. Jump up on the stage and do my money dance. Money dance.
Move your money to SoFi. Earn up to $930 when you download the app and get your money right.
Okay, here's some additional content for the product highlights. Through SoFi, you can invest. They have personal loans, student loan refinancing, money, home loans, credit cards, private student loans, insurance, credit score and budgeting, and auto loan refinancing. For the 1 year chart, you can see that SoFi has seen a return of 105.73% in the past year. Here's some of the latest news articles on SoFi. One that we wanted to focus on that we liked was how Rivian plans to sell a portion of its $60 billion IPO directly to SoFi users. So this would be something that would be offered to SoFi. So Rivian plans to give retail investors the same access to its IPO that it gives to Wall Street. What we like about SoFi, they have a narrow economic moat, they have a 45% long-term growth, a 0.77 forward PEG ratio, and 106% 1 year return.
And for what we don't like that it's above fair value. It has a negative 33% return on equity, and it was just listed on November 30th, 2020. So here we are on Thursday, and one of the companies that we're going to highlight for Thursday is Xpeng. And Xpeng Incorporated designs, develops, manufactures, and markets smart electric vehicles in the People's Republic of China. Its earnings are forecast to grow 75.16% per year. Its revenue grew by 452.1% over the past year, and it's a prominent player in the auto industry.
In the snowflake analysis, it looks like the future growth is looking very strong, and the financial health also looks strong. The other areas are lacking. Now here are some product highlights for Xpeng. First you have the G3, which is a super long-range smart SUV. And next we have the P7, which is a very sleek-looking, super long-range sedan. You can also see the interior looks pretty amazing with a great display for the X Pilot. Now these vehicles also have the X Smart OS in-car intelligence system. So it has 3 screens plus cloud storage. It has an AI smart assistant, it has V2X and infotainment. Here's the 1 year chart. You can see that Xpeng is up 117.61% just in the past year. Here's some of the latest news. We found 3 different articles, but they're all pretty similar. They're all based around the competition between NIO, Xpeng, and Li Auto. And it seems that it looks like Xpeng has had some great deliveries, and it's making the other competitors a little nervous. Xpeng deliveries grew 233% in September. Here's what we like about Xpeng. They have a 13.6. Here's what we like about Xpeng. They have a 13.6 debt to equity ratio. They have 452% revenue growth. They have 118% 1-year return.
And now what we don't like. It's forecast to be profitable in 3 years. It's slightly overvalued, it has no margin of safety, and it has a negative 30% return on equity. And now here we are on the last of the week, Friday. And you can see the companies that are reporting on Friday, and the one that we're going to feature is Honest. The Honest Company Incorporated manufactures and sells baby, personal, and beauty care products. It's trading at 38.9% below the SW estimate of its fair value. Its earnings are forecast to grow 73.07% per year, and its revenue grew by 16.2% over the past year.
If you look at the snowflake analysis, you can see that the financial health looks very strong, and also the future growth looks promising, and it's at a decent value right now.
So with the Honest Company, you can see some of the product highlights here from their website, and you can see they do beauty products, a diaper subscription, baby products, bath and body, hand sanitizers, cleaning products, and they also have clothing now. And also, if you didn't know, Jessica Alba is the founder, and it's interesting because they have an ethical lifestyle brand that inspires everyone to love living consciously. And what's really awesome is that their packaging is now going to be EWG verified, and their products are EWG verified.
And here we have the 1-year chart for Honest Company. And as you can see, it's pretty ugly. Ever since they IPO'd, it's been pretty much straight down. The stock is down 55% for the year, and then it's also down from the previous high, a 63% drop. Okay, and here's the latest news for the Honest Company. One of the articles that we wanted to highlight was from Simply Wall Street. It says companies like Honest Company are in a position to invest in growth. So although the Honest Company right now is losing money, it's burning through its cash, it's also investing in trying to innovate and come up with the best products so that one day in the future it will be profitable. Here's what we like about the Honest Company. They have a 73% long-term growth, 21% debt to equity ratio, 0.19 forward PEG ratio. They have a margin of safety at this price point. It was founded by Jessica Alba, and it's very EWG focused.
And what we don't like, it was listed on May 5th, 2021. It has a negative 55% 1-year return, and there's no economic moat. Now that we've gone through some of the top earnings releases for this week, we hope this makes you a more successful investor as you progress towards financial freedom.
If you like this video, please give us a thumbs up and reach out to us in the comments below. You can also email us and follow us on Instagram.
And our goal is to read every comment and respond as often as we can, so make sure to subscribe to our channel and join us on our FIRE journey to learn, save, and grow together.
Thanks, guys.
Bye.
Subscribe to our channel.
Please.
Subscribe to our channel. Can you please? Tail please.
Say bye-bye.
Get in my dog.
All of our videos are for informational purposes only and do not constitute financial advice. Please do your own research. Consult a certified and trusted financial planner who will put your interests above their own before following any advice we may offer.